Hello folks, this is Les Goldstein from Personal Financial Strategies Incorporated with a February 2016 educational economic update. In this video, we'll discuss some of the economic headlines that influenced markets this past month and give you some insight into what they could mean for you as an investor. Please stay tuned at the end for a required disclosure statement. January was another volatile month for stocks. Investor sentiment turned negative on more bad news out of China and plummeting oil prices. Let's talk about some of the month's major headlines. A first look at fourth quarter economic growth, GDP, showed us that the economy hit a soft patch in the final months of 2015. GDP grew just 0.7%, a significant drop from the 2.0% we saw in the third quarter of 2015. Q4 GDP growth will be revised 2 more times as data comes in, and it's possible that the final result will be more optimistic. However, we're not expecting significant improvement. So, why did the economy slow down? We can attribute a lot of the drop to lower business spending and weak global demand. However, the data also shows that U.S. consumers aren't spending the extra money they save from gasoline price reductions. Does the slowdown mean that the U.S. is heading for a recession? Probably not. This is not great news, but the economy went into negative territory back in the first quarter of 2014 and bounced back rapidly. In other news, the Federal Reserve met in the last week of January and declined to raise interest rates again. That's not a big surprise given the challenging economic and market conditions, but some experts don't think that the Fed made the right call. With so much uncertainty in U.S. and global markets, a rate hike could have given investors more confidence in the economy here in the U.S. On the other hand, inflation remains low and economic growth is modest, so the Fed might hold off on further rate increases for the foreseeable months before us. Earnings seasons kicked off in January, and the overall picture is one of lower earnings and lower revenues. That's not a surprise because we know that American firms are facing major challenges from a slowing global economy, a strong U.S. dollar relative to other currencies elsewhere, and weak commodity prices. But more than 2/3 of the firms that have reported so far have been able to beat their earnings targets, which tells us that managers are doing a good job of managing investor expectations. Now, onto the positive side of things. A gauge of manufacturing blew away expectations and came in at the highest reading since last January. Manufacturing, a backbone of economic activity in many parts of the United States, seemed frozen after several reports showed us that factories struggled with falling or slowing demand. This new data is a refreshing change, and we're hopeful about manufacturing this year, 2016. That's it for our February educational economic update. As always, if you have any questions, issues, or concerns about your personal financial situation or about what we've discussed, please give our number a call. Give our office a call at 847-268-3670. That's 847-268-3670. Ask for me, Les Goldstein, or Robert Hart, or Yvonne Haverland. Once again, this is Les Goldstein with Personal Financial Strategies in Park Ridge, Illinois, signing off for the month of February 2016. Please remember that nothing we talk about here is a recommendation for your own personal investing activities. If you would like to discuss your personal financial situation, please give us a call at 847-268-3670. We will be happy to speak with you. And now for the required disclosure. While we believe the information in this report is reliable, we cannot guarantee its reliability or its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or a solicitation for the purchase or sale of any security. Please consult with us, your financial advisory team, before taking any investment action or making any investment decision. Thank you very much. Have a great month.